How's it going, fellow traders? This is Magic Trader here, and this is your June 13, 2017 CFTC COT report. I published this report yesterday and spent some time with my wife and daughter this morning since it was Father's Day, and we had a good time, went into town, and there was a classic car show in town which we took part in, and it was pretty good. Went for lunch, came back, and now it's time to get back to work. Markets are just opening right now, and we have this data to go through. So here's the data, and we're going to go through each and every currency pair and gold and oil together, and do like we do every single week. Alright, so let's start with gold. What do we see with gold? What's happening with the institutions? So we see that over the this last week, a big drop in longs, right? So we went from 250,000 positions long to 312, which was a very large increase. So we're talking about this candle right here. Okay, that's the candle we're talking about right here, this red one here. So the previous one, when price was heading up high, price got very aggressive, which makes sense because price was breaking through this supply zone right here. And now that it broke through this supply zone, we have a valid demand zone right down here. So we have now, with this candle right here, this bearish candle, we see that the institutions have closed out a big portion of those longs, dropping them from 312,000 to 297,000. Okay, and as that was happening, these last 2 weeks, what do we see? Shorts being aggressive. So if we see one sell, which is this, a sell on Excel, this is called a sell. If we see one sell showing some aggressiveness, it doesn't really tell us anything. It just says for that one, it just tells us that for that 1 week they were aggressive with their positions. But when we start to have 2 weeks in a row where that aggressiveness is still present, then we start to pay attention. So price was aggressive to get up here, and all of a sudden they became aggressive with their shorts. So now that this is a second week in a row where their shorts are still aggressive, now I'm starting to pay attention. So what I'm looking at here is I'm seeing signs of possible hedging. So price gets up high, and instead of closing a massive amount of their longs, if their belief is that price is going to eventually head higher, or if that's what they want to do by pushing price, then they're going to, instead of work really hard closing a lot of their longs, they're just going to be aggressive with their shorts. And what happens with that is that allows them to get out of their longs later, or stay in their longs and be able to get a better entry for their long positions. So since they were adding longs all the way up here, when they add shorts as price gets down, then their average price will become lower. So if price decides to head higher, or if they decide to push price up here, then that'll basically give them a overall average price long a lot lower than where they got in up here. Or what they could be doing is, as price becomes aggressive with shorts, they're forcing price lower to eventually close these longs down here. Okay, but I don't think that's going to happen because they opened these longs up here. By adding shorts, they're basically bringing that average price from up here down to down here. So it's a good strategy. Instead of trying so hard to close all their longs, what they do is, because if they close longs, they need sells, right? And so they'll be filling in sell orders from other institutions or from retail traders, and all those sell positions are going to cause price to just drop. So why not just close some longs, add shorts, force price down, and then you get an overall better price on these longs that you opened up down here. And then once price is down here, if they close those shorts for profit, then they can start adding longs here, for the move to the upside. So that's what I'm going to be watching for, because I am interested in taking longs, and I wouldn't mind taking longs from this area here, only if I see signs that the institutions are playing it that way. All right, because this can easily just drop down to here even further, like that. So that could easily happen. And so what we could see is when price gets down here, we could see those longs begin to close out, and those shorts also begin to close out, and then maybe a bounce from here to back up to this area before a further move to the downside. Or it could just consolidate at that demand zone and then break lower. That could happen. So I'm waiting for signs from the institutions to see what they're doing when price gets down here. But I do believe price is going to get down there. Alright, let's take a look at oil now. Oil, longs become a little bit more aggressive. I mean, we saw a big drop from the previous week, 595 to 624. Now they added just a little bit more to their long positions. That happens with this position or this candle here. And that's happening as price is penetrating deeper into that non-2-to-1 monthly demand area that we have here, right? So this can easily break and price head lower. If that were to happen, look at that. We want to see shorts become aggressively added to, which is what's happening here. Shorts became aggressive, but that could just be for a deeper penetration into that zone to pick up more demand to take price to the upside. So that can happen as well. So looking at the sells, they become neutral. Although 70% of their overall exposure is geared to the long side, the fact that those sells are blue means they're not bullish right now. So it's best to just sit on the sidelines and wait to see what happens, because if this area breaks, I'll look to take shorts down here. But I'm not going to take shorts now because that area could hold and we could get a reaction to the upside. And right now, what do we see? We see shorts being added, and that's causing that big drop in price. But we also see the longs being added to. All right. Yes, long exposure dropped 2 points, and net positions also dropped from 382,000 to 358,000. But remember, we're still at a positive 358,000 positions geared to the long side when you take into consideration long positions and short positions. So these shorts being added to could just be hedging for a better price on longs down here, but we don't know that, and the data is not showing us enough to believe in this 100%. So that's why the data is showing us, yeah, that move is happening for a reason, but for what reason, not sure. That's why I'm waiting on the sidelines to see if price holds and if demand kicks in here, or if this zone is going to break. And if that happens, like I said, I'm going to be looking for short positions. Alright, so let's go to the US dollar. What do we see with the US dollar? Longs are still in neutral territory. Okay, they're cooled off. And we see that shorts are aggressive, holding their aggressiveness. So shorts drop by about 2K, and that happens. This happens with this bullish candle. So shorts being closed means demand has to come in, which causes price to rally up. And what do we have? Long exposure and short exposure remain the same, and net positions remain the same. Still bullish, but no big change. The coloration of the cells show that there's a slight bearish bias, but that would be the case since we've been falling this much. We'd have to see a bearish bias. But what I'm looking to see now is when demand is going to kick in. Excuse me. So what I can see is that longs are pretty much at the average size, and shorts are aggressively above average, which is the cause for the drop. So now what I'm going to be looking for is signs of demand kicking in. So I'll be looking for shorts being covered and longs being added, and then on the charts I'm going to be looking for some demand being created. Okay, so let's look at the Aussie. Aussie longs get closed off from positive 39,000 to 33, and also shorts being closed out. Both of them are cooled off, and net positions is a negative 1.5 thousand. So slight bias to the downside, but if you look at the colorations of the cells, they're neutral, which means don't do anything because there's nothing strong right now. But I'll tell you this: if this area gets taken out, I'll be looking for drops in price to take trades to the upside. And what I would like to see is by the time price gets down to any areas of demand, if the zone's taken out, I'd like to see the institutions showing me that they're getting back into this in a bullish way. So we'll wait and see what happens as this plays out. Right now, very neutral, and it's hard to take a position just knowing that the institutions are so neutral on this pair. Alright, the US CAD, what do we see here? We see that longs remain aggressive, although they did close out about 5K of their longs. But that's during this area of consolidation. So we are consolidating, they closed off their longs, price drops. Because to close longs you need shorts, and so that's what happens. A bunch of supply comes in, closes all those longs, price drops, breaks through an area. Now we got a valid area of supply here. So long exposure drops 1 point to 81%, so long bias still in effect, and net positions drops from 94K to 88K. So bias is still long. I am waiting to see strong demand get kicked in here because right now we got a trend line that's breaking on the weekly chart, and we got a valid area of supply here that when price gets back up it's going to drop. So right now I would take trades off of this area here, targeting this area up here. Alright, that's all. I wouldn't take any longer term trades. What I would wait for is for this area to get tested, and then when it drops again, then I would take trades to the long side. If longs were still aggressive and shorts were still cooled off and this was still bright green in coloration, I would take longs at that point. So that's what I'm looking at here for the US CAD. Let's go on to the US Swiss. What do we see? Not much. Shorts increased by about 2K, and we're getting a reaction from this area of weekly demand, waiting for strong demand to kick in. But then we got this trend line that we got to worry about. So just waiting on the sidelines when it comes to this chart and not really making any moves as of yet. Euro. So longs remain aggressive, but they didn't. They hardly budged over the last week. What we do see is that shorts closed, and that's why we're having this this move up, and then price closes, price drops. So supply comes into the charts. And we still have coloration of the sales green, so bias is still bullish, but I'm not going to go long in a supply zone. Net positions increase from 74,000 to 79,000. So the bias is bullish, and it looks like the institutions are pretty set on making this go up. Look, they just keep on adding to their long positions. What I'd like to see is a move to the downside, and as price moves to the downside, I want to see what they do with their positions, because that will really start to tell me what they've got up their sleeves for the future. Are they hedging because they're going to be adding long? Are they closing off their longs and starting to pile on shorts? All that stuff will be information that I will be watching for in the coming weeks. So on the pound, what we see, both longs and shorts are cooled off or neutral territory. Bias is neutral, don't do anything, although there is a slight bias to the bearishness because net positions increases by another 3K to negative 39,000. So slight negative bearish bias, but the fact that this is both neutral and these cells are blue, I'm not looking to take any trades as of yet. I'm expecting price to drop further down here, and then down here is where I'd be looking to take some long positions. If the chart's set up nicely, and if the data tells me that that's what the institutions are doing, it'll be a beautiful trade from down here and higher. But right now I'm just waiting on the sidelines and not taking any trades. So next, the US dollar Japanese yen. What do we see? We see longs remaining aggressive, although they have closed 10,000 of their longs, and that comes with this candle here. So they closed off longs, price drops, and they close off shorts at the same time. The net effect is long exposure increases by 1%, but net positions drops from positive 55,000 to only a positive 50,000. So the bias is still long. All right, they're still bullish. The fact that these cells are green, okay, and the longs are aggressive. Longs are aggressive, but they're below average size. But shorts are very much cooled off. I'm waiting for strong demand to show up on the charts. I'm waiting for this area to be clearly broken, and then a test of that area to take longs if the data supports a move like that. Alright, Kiwi dollar is the last one, and we got longs beginning to be aggressive. Okay, we got one sell here of strong redness, but we are in a monthly supply zone, so I'm not making any moves. So this long being aggressive could be just that extra push that we needed, and you can see that candle. Tall ERC opens at the bottom, closes near the top, very aggressive, so that makes complete sense. These sells slightly bullish, but not enough for me to make any long decisions, of course, right? So we've got supply in effect right now. Price should react to the downside. I'll be watching to see if indeed they'll start closing off their longs and start adding to their shorts, and if that happens, I'll be waiting for strong supply to come into the charts, and then I'll be looking to take shorts on the way down. Alright, so that's pretty much it, and I think we have some data being released on Wednesday. Yeah, on Wednesday we got the New Zealand Kiwi releasing the interest rate, which will get things to move. Besides that, we'll see what happened. We had a lot of data coming out last week in terms of rate releases, so I think this week will be a pretty decent week in terms of volatility. And that's pretty much it, guys. Hope this was helpful in your trading for this week. And until next time, take care.